All right, guys. So today we're going to get into a few things, some which we've kind of touched on, but today will kind of be the full breakdown of it. So what we'll be touching on is swing points, swing highs, swing lows, and then kind of the difference between that, like valid highs, valid lows, which and what you would kind of use the swing highs and swing lows for, versus understanding valid highs, valid lows, but knowing that this all is in the same umbrella under market structure. Now, first and foremost, um, because these next bootcamp videos will be um, further expanding on the basics, it is very, very imperative to have a solid foundation of the basics. When you get to a certain level of trading, if you do not have a strong foundation, anything that is additional will hurt you more than help you. Um, but again, well, I'm saying that to say that as of right now, that everybody that is trading, that has went through the basics, feels like they have a firm foundation of the basics, you guys should have a trading plan. It is super, super imperative to be tactical when it comes to trading. You know what you want, you know what your goal is, you know what you want to do, and you're just executing that. When you are in the market indecisive, you will get indecisive results. One day you might want to hold, one day you might want to take profit. One day you might want to do this, the next day you might do this. Having a trading plan holds you guys accountable, and it is very, very imperative when you start trying to do more. Um, you know, learn more topics, and then you don't even have something to stand on. It can become very, very hard. Uh, to try to figure out how to do both at the same time. So with that being said, first thing I'm going to share with y'all um, is my trading plan, what I used, and what I kind of still do use from time to time. But this, I think this was extremely helpful to people that's especially beginners if you do not have a trading plan already. Um, Let me actually, I'm gonna have to unshare this real quick. Put my Telegram. Let's see. Oh, you guys aren't able to see my Telegram. That's fine. Okay. All right. That's cool. So with let's see if I can try to place it on here. Hmm. That's fine. I'll copy and paste it into the Telegram and I'll just explain it. All right, guys. So I went ahead and sent the trading plan in the Telegram. When I was screen recording this, I was able to just pull it up. But since it's recorded just the platform, I'll just explain it. So with this trading plan, guys, my goal, or a good goal of mine, was $600 days. Right, starting off $600. That was pretty achievable, knowing my risks, and so understanding that I would do. I'll understand that in order to make that, I would need 60 pips on one contract, or 30 pips on two contracts for my setup. And with that, you should always have a plan for going break even. Break even means bringing your stop loss to where you enter the market at, and that will make your trade risk free. So if it comes back, you'll get tapped out. You won't make any money, but you won't lose any money. So my um, goal that I set for myself was at break even. Once I got a 15 pip push, that's when I would bring my stop loss into profit. And then after I got a 30 pip push, that's when I would start bringing my stop loss from break even to drag it into profit. That amount, I would usually trail it 15 pips at a time and keep going up from there. And then my stop loss was $350, right, on one pit on one contract. that's 35 pips. On 2 contracts, that's 18 pips, right? And so with this, I had a 2 clap rule. If I lost the first trade, I can only enter into one more trade, and that was it. Let's say I was looking at a setup where I wasn't able to set up my pending, right? But it was still in my entry zone, right? It was still in that zone between the 618 and the 886, right? I would just market execute, but I would only do that on one contract, not two, not three, just one. And so with that, that was my full plan for coming in and out the market. Now, you do not have to copy this plan exactly. If you do, great. I have done it. I have done it with my mentees over and over and over. I will challenge myself. Like, I will get combines just to show people that you can pass a combine. And so I did this I did this in September with this exact trading plan, and passed the account with this trading plan. It did not take me 5 days. It took me 9 days if we're counting the weekend. And so I've done this plan. This plan works, and I believe this is very, very. It's a solid plan. You can lose about 2 times before you win a trade that will make you break even. So if you win one day and then lose 2 days, your account will be break even. That's a good way to think about risk to reward ratios, and that kind of helps you hold on to these accounts a little bit longer rather than just going through accounts, going through accounts, and going through accounts, right? When you have a plan or a goal, when you lose, you step away. You have something to hold you accountable to, and that will ultimately make everyone a better trader. Now, another tip that I wanted to pass on with everybody is that when it comes to passing funded accounts, one thing that I picked up on just over the years was seeing that most people they switched their account, their charts and data from the dollars to the ticks, right? As cliche as it sounds, disassociating yourself with the dollar as much as you can when it comes to trading is super, super important, right? Ticks help you better realize you're targeting a risk versus reward rather than I'm targeting a profit goal or a profit margin. This breakdown, when it comes to using your tool, will go hand in hand, right? So if I was to click my date and price tool and I had a entry, let me see if I can just get something real quick. Like if I had an entry like this, right, and I understand my pending order would be right here, I could draw this out, and when I enter my trade, it will say 63 pips, and I could just calculate that, do the math, and understand, okay, a 1-to-1 would just be 63 pips in profit, right? So about right here, 61, about in this range could be my TP1, right? We understand that it comes to understand when you know the nature of the chart that you're targeting either the lower low or the higher high, right? Whatever trend that you're in. If we're in the pullback to make the lower low, right? We understand that this is also TP2 essentially, right? The new low. Our TP3 would just be a 1-to-3 from whatever our risk is. And that is typically what this setup gives you, right? Because we understand when you make that lower low or that higher high, you're typically going to push past that lower low or that higher high. You're not just going to meet at that higher high or that higher low, because then that becomes liquidity, right? Equal highs results in a sweep, right? So we understand that we're targeting the higher high, and then our TP3 is past that high, right? So you have your 1-to-1 first, achieving the new high, and then past the new high. That's how you sort of break this down and understand when to take your wins, when to take your profit, and also protecting yourself from a reversal when it comes to trading, right? We can only predict the market up until a certain point. Like right now, we understand we should be expecting a reversal, because what did we achieve on our higher time frames? The new high. We broke structure to the upside. Now we should be having a pullback, to then shoot off, right? Understand that's the nature of the chart. So that is why it's important and imperative to understand and have a solid foundation of structure, your risks, and not just take any setup that comes your way, right? Um, Now, that's pretty much it regarding trading plans. Now we can actually get into um, steak and potatoes. So, first thing first is understanding swing points, right? What are swing points? Now, swing points are places where price pushes up or pushes down to that creates a large range of structure, right? So our swing points is going to be our wicks, right? We're going to count our wicks as swing points. So right here, this is a swing point. 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 Now, typically, your swing points are going to go hand in hand with higher highs and higher lows, right? A valid high or a valid low. However, that is not always the case, right? You could have swing points like this, right, where price pushes all the way down here, and this is the lowest wick, right? That is a swing point that is not necessarily following a two candle close rule, right? Swing points are different. Up here, this is a swing point, right? Understanding that swing points involve the wicks, right? You're not necessarily paying attention to the candles when you're identifying swing points. Now, what qualifies a swing point, or not necessarily what qualifies a swing point, the same way that you would label a higher high and a higher low, same thing, except you would just call it a swing high or a swing low, right? So if we're on the upside, right, this is a swing high, this is a swing low, swing high, swing low. Let me mark this on real quick. So we have a swing high. All right. So if our swing high, swing low, swing high, swing low. Now, understanding that, right, this is what structure is going to look like on a smaller time frame if we're in an uptrend, right? This is what structure is going to look like on a higher time frame. We are going to have, let me kind of fix this real quick. On our higher time frame, right, it's going to be less breakup structures, right? It's not going to be so much, breakup structure to the upside, higher highs, higher lows. There's going to be a few of these when it comes to seeing structure. That's why structure is clear on these higher time frames, right? It's less breaks of structure. It's easier to tell the trend. The higher time frame trumps all. We know this. Now, swing highs and swing lows target this overall range. It helps you determine the overall range way better, right? So when we're marking up our swing low and swing high, right, this area is going to cover the totality of this area. These higher time frame markups will help you clearly visualize where you should be entering on your lower time frames. Now, if we're incorporating our valid high and our valid low rules with our swing high and swing low rules, we'll understand that with here, we just broke structure to the downside, right? So our swing high and our swing lows or our ranges will help you see where do I take the trade. Now, before we dive into entering and exiting the market, we need to understand what is considered a valid swing high or swing low. Now, with swing high and swing lows, right, you can either have a swing low or a swing point essentially in a a 3 candle sequence, or a 5 candle sequence. Now, with this, right, with this swing low right here, this is a 3 candle sequence. So we have this, and you can clearly mark it up. This is our wick, our lowest point. We have 1, 2, 3. All right. So in this range of 3 candles, we got this long wick, right? We got this wick that's lower than this wick, and then we have this wick that's lower than this wick, right? Now this wick or this candle closes above, right? So we would consider this. We wouldn't consider this. Actually, we would consider this because this wick is lower than this. It's not by the candles, it's by the wick. So this is actually a 5-point swing. And anytime you're understanding swing highs and swing lows, you're going by the wicks, right? 4, 5, right? It's basically the easiest way to depict it is like a triangle, or not a triangle, like a pyramid. So you have this movement, right? This would be the wick, right? And then this would be the second candles, the pairs right here, and then the third candles right here. So it'd be 1, 2, 3, 4, 5. So we have 1, 2, 3, 4, 5, right? Each of these wicks, this wick is lower than this wick, this wick is lower than this wick, this wick is lower than this wick, and this wick is lower than this wick, right? So this is a 5-point swing, right? Now, what would be a 3-point swing, right? This perfect example. This is a 3-point swing. No, that is a 5-point. We got 1, 2, 3, 1, 2, 3. Let's see if I can find a 3-point swing. Here we go. This would be a 3-point swing. So we have one right here, a wick right here, 2 wicks lower on the right side, and then this wick right here is higher than this wick. This wick is lower. However, you need these two to match up, right? These both need to be lower to be considered a 5-point swing, right? So with that, the difference in the 5-point swings and the 3-point swings is not necessarily which is stronger or more powerful. It's more so the fact that 5-point swings are just easily more visible, right? Because we can see here, if we're looking at structure, our 5-point swings will be clear, like boom, 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 boom. Actually, this is a 3-point swing. That's what I was looking for. 1, 2, 3, 1, 2, 3. And then this wick is higher than this one. So, like I said, our 5-point swings will be much more powerful, much more noticeable, right? Our 3-point swings, still, when we're understanding swing structure, the markup is still going to look like it's still going to be areas where you can catch trades. However, your major moves are going to be with your 5-point swings. Like I said, you can still analyze with the 3-point swing. It's not like one is better than the other. It's just more so one is more noticeable, and it's more visible. And essentially, when it comes to entering the market, you want that clarity. So I guess you can't say 5-point swings are better. But if you mark up a 3-point swing, don't think like, oh no, I can't use this. That is still fine as well. Now, with understanding what makes a valid swing high and a swing low, now when it comes to our entries, it'll be much easier to see what side do we want to be on. So if we have this first range, right, from the swing high to the swing low, you're still going to draw your fib the same, right? We just broke structure. Oh no, right here, down here. We just broke structure to the downside, so we should be expecting a pullback, right? So we broke structure. Boom, draw your fib from this swing high to this swing low, and boom. Now we're gonna highlight the 2 areas in which you would be looking for a trade. If we close below in real time, right? Let's say let's say the right side of this graph wasn't here and just this left side. As soon as we see this candle push below this low, we understand we can take the sales down, right? If y'all seen trades by ICC, this is how he trades. He marks up a swing high and swing low, and then once either the swing high or the swing low is broken, then he just enters the trade and then puts his stop loss right here at the last swing high, right? He'll get this push of continuation and call it a day, right? Now, ICC is just called a more so break and retest, right? It's not hard to learn. Again, when you understand your swing points, it's actually very, very easy to trade like that. But as far as this scenario, we use that concept of understanding swing highs and swing lows when it comes to looking for entries. Now, the two zones where you'd be looking for a sale, right? As soon as structure breaks, right? As soon as we get this close below this previous low, we know that we are now in a downtrend. So the two areas you're looking for a sale would be in this range and in this range. Now, once you do all this, right? Once you mark up your swing highs and swing lows, it makes it very, very easy to see where you want to enter the market at, right? So now, boom, I'm following structure. I know we just closed below, right? I have my areas highlighted. So what I'd be looking for is just an entry to this downside. And right here, I get it, right? We was pushing up, right? Simple, that's just a pullback, essentially. It was a pullback to here. Close below. Any of these will do, honestly. Just draw your fib. Drew your fib from the previous high to the newest low. Pull back. Stop loss on the one. Barely touches the one. Almost did. All this is you. That whole drop off is you. Once you get that close below. And that's just by understanding what side of the trend that you're on and what's your optimal trading entry, right? Now, this pullback, do we see a potential plays to the upside? Yes, you do. However, this is not part of the trend that you want to be on. The more powerful move is the downtrend, right? We see on the 1 hour, it followed it to the T, right? It came back, pulled back, everything was a zone. Our order block was in a zone. We had a fair value gap in here. Again, almost touched the one. It did not. Make sure you guys stop losses on the one. You will have this sometimes where we'll push all the way, have a deep retracement, and then tank. As long as your stop loss is at the one, it will never tap you out. But again, understanding that this is happening on our higher time frame, on a lower time frame, we're just looking for entries. Now, if we look to our highlighted zone, you can clearly see, boom, got an entry right here. Perfect. Order block in the zone, fair value gap next to it, came, tapped it, tanked. I mean, y'all, again, y'all see this probably did 1,000 pips. The goal is to trade efficiently, right? When you mark up these swing highs and these swing lows, it'll help you see where I'm actually trying to trade at, right? Less is more when it comes to trading. Less is more. You do not have to sit here and be on the charts all the time, 24/7, looking for a trading entry. I get being new and beginners, you might do that, but there are ways to just be more and more efficient, right? There's about 2 to 3 trades per day that happen that are like the premium setup, right? Everything else is just like a retest, or if we're following structure like this is the easiest way to explain it. The first trade that you want to catch is that breaker structure to the upside. You want to catch the trade down here. This you want to enter in this well specifically here, right? So that you can catch this trade the whole way up, right? A lot of times when people are entering later in the markets, they're catching these trades, right? After the breaker structure, after the retest, right? The breaker structure is super, super powerful, right? After you understand your swing highs, swing lows, you get your breaker structure. These are the plays that you're looking for, right? The plays after a breaker structure. Now, what most people get or don't understand is that these moves don't happen as often, right? We understand that gold tends to move the opposite direction based off whatever session that we're in, right? So in the morning, if it's bullish, at night it's going to be bearish, right? Because essentially, if we're understanding the trend, it's going to take the whole day to get that push up, and it's probably going to take the whole night or a quarter, 3/4 of that night to get a retracement, right? So most people are not understanding, well, I just need to catch this first break of structure, right? That aligns with my swing highs and my swing lows. That way I can be more efficient and I don't have to sit here and just scalp all day. You don't have to do that. Less is more. And the more you realize that in itself, especially when it comes to futures, the more successful you will be, the more patient you will be. When you have these larger wins after doing all these markups and analyzation, you will see that again, less is more, and there's ways to just be more efficient. Now, let's see here. Let's pull up another example. Let's see. Let's go to the 4 hour. Swing highs and swing lows. It's the easiest to do on your higher time frame. Actually, I probably suggest that you only do it on the higher time frame. I could just clear this out like this. When you understand the concept that there is a range within a range, you'll understand why you're marking up swing highs and swing lows on a higher time frame. Like if you're marking up swing highs and swing lows on, let's say, the 5 minute or the 15 minute, that means you would be looking for entries on the 1 minute or the 3 minute, right? You would have to literally enter the market on a smaller time frame from whichever you choose to mark up your swing highs and swing lows. It's easier to do it on your higher time frames because structure is more clear. These swing points are much more easier to see, like this and this, right? Right here is our swing low. It's our swing high. Right? We just broke structure to the upside. We closed above this, right? Lower low, lower high, lower low. Cool. Break a structure. Boom. We should be expecting a pullback to then shoot up. That's exactly what it did. Came, touched this order block, shot off. Now, same thing. I should be having entries here and here, right? I should not be concerned with the pullback. That is against the trend. Now, I'm on the higher time frame. Does that mean you cannot catch trades in here? Yes, you can. However, what's going to be favored is the push up, right? You are looking for this. All right, depending on what trend that you're in, right? If we're in an uptrend, this is what you're looking for. I mean, a downtrend is just the opposite. All right, you're looking for these moves in a downtrend. Because you understand your entry is really going to be at these pullbacks. These pullbacks are coming right to that order block in that fair value gap for your entry. And this is, you're just catching this every single time. So that's why swing structure is so important to see, right? And you can incorporate this in your valid highs and valid lows to understand what I'm trying to do. We just broke above. I got my swing low, my swing high. Cool. Now I can just look in a 5 minute and see, all right, where are my entries, right? Pretty much all along here, you're going to find entries that correlate with what you need, right? At some point, like, looks clear right here. This one looks like it pulled off the 702. Yep. Pulled off the 702 to a T. Everything was there, was clear. Boom. Shot off, right? Probably had an entry. I mean, even in here, it ended up dipping below. But this is still catching it towards the trend. Catching it towards the trend. The goal is to catch it towards the trend. And then here, as you can see in our pullback, there's just an immense difference as far as opportunities. Like I'm even just eyeballing and knowing entries. I'm like, I'm not seeing anything that's clean and clear on this pullback where you could have entered. Maybe right here in this segment, could have got a little bit something, but even then, it started consolidating, right? This was not the move. You're not looking for this. This is only a means to just pull back to this 702 on this higher time frame, which is really the goal is this order block, right? So there's no method to this. There's no need for, forming valid structure, forming entries, to the upside. There's no need when you're pulling back. You're just targeting an order block or a gap, and that's it. Your entries are going to be on the side that's favorable or the side that's in domination, whatever trend is in domination at that point, and that is the buys. So again, we can look to see, all right, our highlighted area after it tapped this order block in 702, right? Again, probably multiple entries here throughout the day. This looks like it came and tapped the 702. Nah, almost. Just missed you. Came, tapped the 618, which you can pull off the 618. It favors a deeper retracement, but as you can see, it just came and filled in this gap 50%, which again still follows everything according to how you trade. We just like deeper retracements, but that was there. Let's see. I wouldn't trade in this. This isn't as clean. Understanding liquidity, you'll understand why this is valid, because you can just look at this and determine that this is liquidity. This ain't, when it comes to identifying liquidity, there is no valid highs and valid lows in this. This is just wick, 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 wick. So that's why you can draw it from this highest point to this lowest point. That'll help you a lot when you see setups like this. Don't take none of this for structure. This is just liquidity. No clear direction, right? We are clearly in an uptrend. This is essentially an additional confirmation for you. But again, another entry came, tapped this order block to a T, shot off. We got some consolidation. Let's see, we got another entry. No, that's pretty much it for the day. We should be, the move pretty much was what made, we cleared the new high, right? This is when you want to start being careful. Whenever you push past or close above this high, right? That's a confirmation of continuation. However, we understand that the chart must pull back at some point. And this is when you kind of look to see reasons for a pullback. Why would the chart pull back, right? We still have a gap that we understand that price likes to come back and reverse. So we know that, okay, it can fill, create a pullback, and then shoot off. Again, on our 1 hour, we're right here at this midpoint of this gap. Price can push up to this a little bit more, pull back, and then shoot off, right? So we have reasons to say, okay, we might get a pullback. Just understanding the chart, understanding your confluences. And that's why when you're understanding or marking up your swing highs and swing lows, catching a buy up here is not the best thing. Pretty much that move has been made, right? You should just wait for this next, after the pullback, just wait for this move, right? Catching it that high is just very, very risky. I mean, you can even mark it up and see. Um, like that's a lot of pips to go in one direction and then to just continue it a tad bit more. And the way that like, well, Aaron, how would you know, like, not to get into a buy at this point after the move is already made? Just back test it. Go through these other setups that possibly happen and see, okay, how high did a high actually go, right? And when you're understanding the nature of the chart, you understand the chart's going to make higher highs and higher lows. Just go back and look, okay, how high did it actually go? How low did it actually go? That'll help you determine when it's like, okay, even if I see a setup in here, right, I may not necessarily want to take it because we pushed so high, right? And then also doing further analysis, understanding we have reasons for a pullback. So that wouldn't be the smartest entry. And this is what I mean when you're going to get to a point where you're going to see setups, but you're not going to take it, right? Setups can be clean and perfect. Everything can be there, a fair value gap or order block. Everything could be there. But the market analysis will save you, right? If I'm coming back and I'm zooming out and I'm saying, wait, we have reasons over here why I might pull back. We have different things that suggest, price pushed up so high. We have reasons being like, okay, maybe I'm not going to do it at this point. We're kind of late in the trend, right? That is a great thing, right? Being patient with trading is super, super, super important. Like I said, these moves are happening over days, right? So as long as you can tell yourself like, okay, I may not see something clean today. We may be in a pullback this whole day, right? This pullback was pretty much all last week, right? Nasty. I mean, of course, there was entries in here. Like, yes, yeah, it was some sales in here, but this is what you wanted. You wanted something clean and clear. This is what you want to trade in, especially if you want on higher time frames and seeing this, right? This is what you want to catch. Another thing when it comes to price being this high, what can help you enter into the trade again is if you see two candle closes, right? If you see a valid low that's created, so let's say you saw something like this, right? And it shot back off, a small low that was made. So if this candle was red, we understand that after we make our valid lows, right, we're pushing up to make the new high. That can also help when it comes to understand, okay, when can I enter back in on an uptrend, right? You just need a valid low. Again, the trend is not defined by this. The trend is defined by these higher highs. So yeah, that will wrap up everything considering swing points, swing highs, swing lows. Again, you're going to have your 3-point candles or your 3-point candle swings, your 5-point candle swings. And then again, understanding how to incorporate market structure, valid highs, valid lows with understanding your swing points. This will kind of better help you picture, seeing a range within a range. And all that means, in simpler terms, is understanding that in these larger time frames, we're going to have smaller time frame structure that's better geared for your entries, right? But you're overall catching the trend, right? You're making plays to catch the major trend, right? These are trades that you can feel more confident in holding because you did the analysis behind it and you understand which trend is dominant, right? You don't want to trade against the trend. You can trade against the trend. However, you're going to need to be trading much more often, right? It's going to be a lot more break even, stop losses, pushed up into profit, a lot more consolidation, all those things, right? You're going to get that when you're trading against the trend, rather you're trading with the trend. 9 times out of 10, I mean, it just taps your entry and just moons. I mean, bam, bam, right? Um, but yeah, that will wrap up this boot camp. The next one we will be talking about more so incorporating the fib with swing highs and swing lows. Um, and then we'll go over order blocking and fair value gaps. But yeah, that's pretty much it for this one. All right, let me stop the